I want to tell you about two couples. Both retired comfortably. Both had done everything right. Both had savings, Social Security, a paid-off home. Both felt financially secure. Couple number one, the husband had a stroke at 74. He needed 2 years of skilled nursing facility care before he passed. The cost? Just over $200,000. Their retirement savings, which took 35 years to build, were cut nearly in half in 24 months. His wife, now 76, is living on Social Security alone. The cushion they built together is gone. Couple number two, same age, similar savings, similar life. The wife was diagnosed with early onset dementia at 72. She spent 7 years in a memory care facility before she passed. Total cost, over $630,000. Her husband had to sell their home, exhaust every account they had, and spend down to almost nothing before Medicaid finally stepped in. These are not edge cases. These are not rare tragedies that happen to unlucky people. According to the U.S. Department of Health and Human Services, 70% of Americans who reach age 65 will need some form of long-term care during their lifetime. 7 out of 10. And the average cost of that care, depending on the type and duration, ranges from $50,000 to over $100,000 per year. This is the retirement risk that most people never plan for. And today we are going to change that. Hey everyone, welcome back to Life Advice. I'm your name. Today we are talking about long-term care, what it actually costs, why most people are completely unprepared for it, and exactly what you can do right now to protect yourself and the people you love from what could be the most financially devastating event of your retirement. Let's get into it. Let's start with the basics because there is a lot of confusion about what long-term care actually means, and that confusion is part of why so many people fail to plan for it. Long-term care is not the same as medical care. It is not hospitalization. It is not surgery. It is not your regular doctor visits or specialist appointments. Long-term care is the ongoing assistance with the basic activities of daily living. Things like bathing, dressing, eating, using the bathroom, moving from a bed to a chair, and managing medications. That becomes necessary when a person can no longer perform these tasks independently due to aging, illness, injury, or cognitive decline. And here's the critical distinction that most people miss. Long-term care is not covered by Medicare, not meaningfully. Medicare covers short-term skilled nursing care after a qualifying hospital stay, and only for a limited period. After 100 days, Medicare coverage for nursing facility care ends completely. Everything after that is on you. Your regular health insurance does not cover long-term care either. Neither does your Medicare supplement or Medigap policy. Long-term care is an entirely separate category of need and an entirely separate category of expense that sits outside every insurance product most retirees have. So who pays for it? There are really only 4 options. You pay out of pocket from your own savings and assets. You qualify for Medicaid, the government program for low-income individuals. But to qualify, you typically have to spend down virtually all of your assets first. You have long-term care insurance that covers the costs. Or a family member, usually an adult child or spouse, provides unpaid care themselves, sacrificing their own income, career, and well-being in the process. None of these options are painless, but some are dramatically better than others. And the time to choose which path you are on is not when you need care. It is right now, while you are healthy, while you have options, and while the cost of preparing is far lower than the cost of being unprepared. Long-term care comes in several forms, and understanding the different types helps you understand the cost spectrum. Home health care is care provided in your own home by a licensed aide or nurse. Adult daycare is structured daytime programming and supervision outside the home. Assisted living facilities provide housing, meals, personal care, and some health services in a residential setting. Memory care facilities are specialized units designed specifically for individuals with dementia or Alzheimer's disease. And skilled nursing facilities, commonly called nursing homes, provide around-the-clock medical and personal care for individuals with serious health needs. Each level of care carries a different cost, and most people who need long-term care do not stay at one level. They progress through multiple levels over time, with costs escalating at each stage. Let's talk about what this actually costs, because until you see the real numbers, the urgency of planning for this does not fully register. According to the Genworth Cost of Care Survey, one of the most comprehensive annual studies of long-term care costs in the United States, here is what care costs today across different settings. A home health aide providing 44 hours of care per week costs approximately $61,000 per year at the national median. In higher cost of living areas like New York, California, or Massachusetts, that number can exceed $80,000 or even $90,000 per year. An assisted living facility costs approximately $54,000 per year at the national median. Again, in high-cost states, $70,000 to $90,000 per year is not unusual. A semi-private room in a skilled nursing facility, a nursing home, costs approximately $94,000 per year at the national median. A private room costs approximately $108,000 per year. And memory care, the specialized dementia and Alzheimer's care that a significant portion of retirees will eventually need, typically costs 20 to 30% more than standard assisted living. At many facilities, memory care runs $6,000 to $9,000 per month. That is $72,000 to $108,000 per year. Now let's look at duration. Because the cost per year is only half the equation, you also have to account for how long care is typically needed. The U.S. Department of Health and Human Services estimates that the average length of a long-term care need is approximately 3 years. But that average hides a very wide range. About a third of people who need long-term care need it for less than 1 year. About 20% need it for 5 years or more. And for individuals with Alzheimer's or other forms of dementia, which affects approximately 1 in 3 Americans by age 85, the duration can be 8, 10, or even 15 years. Let's do the math on a realistic scenario. Say your spouse or partner needs 3 years of assisted living care at $54,000 per year. That is $162,000. If they then transition to a skilled nursing facility for 2 more years at $100,000 per year, which is very common as needs escalate, the total is $362,000 for one person over 5 years. Now consider that both spouses may eventually need care, not simultaneously but sequentially. It is not uncommon for a couple to face total long-term care costs exceeding $500,000 to $700,000 over the course of their combined retirements. And that is at today's costs, before accounting for healthcare inflation, which historically runs at 5 to 6% per year. That $94,000 nursing home today could cost $175,000 per year in 15 years. This is why long-term care is the retirement risk that most planning frameworks fail to adequately address. It is not a small line item. For many families, it is the single largest financial event of their entire retirement, larger than any market correction, larger than any tax bill, larger than any other unexpected expense. Now let's talk about the 3 most common mistakes people make when it comes to long-term care planning, because understanding the traps is the fastest way to avoid them. This is by far the most widespread and costly misconception in retirement planning. Survey after survey, including research from the Kaiser Family Foundation, finds that the majority of Americans approaching retirement believe Medicare will pay for nursing home or assisted living care if they need it. It will not. Not in any meaningful long-term way. Medicare will cover a short-term skilled nursing stay after a qualifying hospital admission of at least 3 days, but only for up to 100 days, and with significant cost sharing after day 20. After 100 days, Medicare coverage ends entirely. If you need ongoing custodial care, help with bathing, dressing, eating, Medicare pays nothing, zero. For most long-term care needs, Medicare is simply not a factor. The confusion likely stems from the fact that Medicare does cover medical care comprehensively. But long-term care is not medical care, it is custodial care. And that distinction, a distinction most people do not learn until they are in a crisis, is the difference between a covered expense and a $100,000 per year out-of-pocket bill. Trap number 2, planning to rely on family. Many people, when asked what their plan is for long-term care, say some version of, "My kids will take care of me," or "My spouse will take care of me." And while family caregiving is a genuine and meaningful option, it comes with costs that are rarely fully considered. The financial cost of family caregiving is significant. A spouse or adult child who reduces their work hours or leaves the workforce to provide care loses income, career advancement, and retirement savings contributions. Research from AARP estimates that the average family caregiver sacrifices approximately $300,000 in wages, pension benefits, and Social Security over their career. That is $300,000 taken from your child's retirement to fund your care. The physical and emotional cost is equally real. Family caregiving is one of the leading causes of caregiver burnout, depression, and health deterioration among middle-aged adults. The stress of providing intensive daily care, especially for a parent with dementia, can be genuinely devastating for the caregiver and for the family relationships surrounding it. Relying on family is not a plan, it is a hope. And the most loving thing you can do for your family is to have a real plan that does not require them to sacrifice their lives and their futures for yours. Long-term care insurance, which is the most straightforward financial protection against these costs, is medically underwritten, which means you have to qualify for it. And qualifying requires being in reasonably good health at the time of application. Once a serious health diagnosis occurs, a heart condition, a neurological issue, diabetes complications, cancer, Coverage either becomes unavailable or dramatically more expensive. Many people who recognize they should have planned earlier find themselves uninsurable by the time they finally try to act. The ideal window for evaluating long-term care insurance is between ages 55 and 65. Premiums are meaningfully lower, often 30 to 50% lower than they would be at 70 or 75, and the probability of qualifying is much higher. Every year you wait past 65, the cost goes up and the availability goes down. This is not a decision that rewards delay. So what can you actually do? Here are the 4 legitimate planning options for long-term care, with honest assessments of who each one works best for. Self-insuring means setting aside a specific pool of assets specifically earmarked for long-term care expenses, not your general retirement portfolio, a separate, designated reserve that you do not touch for anything else. This approach works well for retirees with significant assets, typically $1.5 million or more in liquid investments, where a $300,000 to $500,000 long-term care reserve does not meaningfully compromise their retirement income or lifestyle. The advantage is simplicity and control. No premiums, no insurance company risk, no policy complications. The money is yours, and if you never need it, it passes to your heirs. The disadvantage is that it requires enough assets to credibly fund potential care costs without destabilizing the rest of your retirement plan. For retirees with $600,000 or $800,000 in total savings, dedicating a large portion to a long-term care reserve may leave insufficient assets for day-to-day retirement income. It also does not protect against the extreme tail risk, the 7 or 10-year memory care situation that can cost $700,000 or more. Option 2. Traditional long-term care insurance. Traditional standalone long-term care insurance policies pay a daily or monthly benefit, typically $150 to $300 per day, when you need qualifying care. Benefits are triggered when you are unable to perform 2 or more activities of daily living or have a cognitive impairment. Policies typically have an elimination period, a waiting period of 30 to 90 days before benefits begin, and a benefit period of 2 to 5 years or lifetime. The advantage is comprehensive protection at relatively low cost compared to self-insuring. A couple purchasing policies in their early 60s might pay $3,000 to $6,000 per year in combined premiums for meaningful coverage. Compared to potential $100,000 per year care costs, that premium is a modest price for significant peace of mind. The disadvantage is the use it or lose it nature of traditional policies. If you never need care, you have paid premiums for years and received nothing in return. And the long-term care insurance market has experienced significant instability. Many carriers have exited the market, and premiums have increased substantially for existing policyholders in recent years. This has become one of the most popular long-term care planning strategies in recent years, and for good reason. A hybrid policy combines a life insurance or annuity contract with a long-term care benefit. You make a lump sum payment or a series of payments into the policy. If you need long-term care, the policy pays benefits. If you never need care and pass away, a death benefit goes to your beneficiaries. If you change your mind, many policies offer a return of premium option. The advantage is that your money is not lost if you never need care, unlike traditional long-term care insurance where unpaid premiums simply disappear. The death benefit ensures your family receives something regardless of outcome. And hybrid policies typically have fixed premiums that cannot be raised, eliminating the premium instability risk of traditional policies. The disadvantage is the upfront cost. A meaningful hybrid policy typically requires a lump sum payment of $50,000 to $150,000 or ongoing premiums that are higher than traditional policies. This is not the right option for everyone, but for retirees with liquid assets they want to earmark for protection, it is one of the cleanest solutions available. Medicaid is the payer of last resort for long-term care in America, and it pays for the majority of nursing home care nationally. But qualifying for Medicaid requires spending down virtually all countable assets to very low thresholds, typically $2,000 or less in most states for an individual. Strategic Medicaid planning, working with an elder law attorney to legally protect certain assets through trusts, transfers, and spend-down strategies, can sometimes preserve a portion of your assets for a spouse or heirs while allowing Medicaid eligibility for care. But this is complex, highly state-specific, and requires careful advance planning, typically at least 5 years before care is needed due to Medicaid's look-back period. Medicaid planning is not glamorous, and it is not the first choice for retirees with significant assets. But for those who did not plan ahead and find themselves facing care costs with insufficient resources, an elder law attorney can be one of the most valuable professionals they ever hire. Here is something that does not get discussed enough in financial planning circles. Long-term care planning is not just a financial decision, it is a family decision, and it requires a conversation, an honest, specific, sometimes uncomfortable conversation with the people who will be most affected by whatever happens. That conversation needs to cover several things. Where do you want to receive care if you need it? At home, in an assisted living facility, or somewhere else? What are your preferences around the level of care you want and the level of independence you want to preserve? Who in the family is realistically able to provide or coordinate care, and who is not? What assets are available to fund care? And critically, does everyone in the family understand the actual costs involved and have a realistic picture of what care actually looks like? These conversations are uncomfortable. Nobody wants to sit around a dinner table discussing their own potential cognitive decline or physical dependency. But the families who have these conversations early, who make decisions together before a crisis forces the conversation, are infinitely better positioned than families who have to make these decisions in an emergency room waiting room or in the immediate aftermath of a devastating diagnosis. If you have adult children, have this conversation with them this year. Not to burden them, not to make it their problem, but to give them the information and the peace of mind of knowing that you have a plan, that you have thought about it, that they will not be left to figure it out alone in a moment of crisis. And if you have a spouse or partner, have this conversation together. Make sure you both understand what protections are in place. Make sure you both know where documents are. Make sure you both know what the plan is if one of you needs care before the other. Planning for long-term care is one of the most loving things you can do for your family. It is not admitting defeat. It is not being morbid. It is being responsible with the years you have built together. Let me leave you with the most important takeaway from everything we covered today. Long-term care is not a distant, abstract possibility. It is a statistical probability. 7 out of 10 people who reach age 65 will need it. The average cost runs into the hundreds of thousands of dollars, and virtually no standard retirement plan accounts for it adequately. But here's the good news. This is a solvable problem if you address it before you need it. Whether that means purchasing a hybrid policy, setting aside a dedicated reserve, reviewing your Medicaid planning options with an elder law attorney, or simply having the family conversation, there are real, actionable steps available to you right now. The 2 couples I told you about at the beginning of this video did not fail because they were careless or irresponsible. They failed because nobody told them this was coming. Nobody walked them through the numbers. Nobody helped them plan for the one expense that ultimately undid everything they had built. You now know what they did not know. And that knowledge, if you act on it, is worth every dollar it costs to protect your retirement from the long-term care crisis that 70% of us will face. Here is your homework this week. 1. Look up your state's average cost for assisted living and nursing home care using the Genworth Cost of Care calculator online. Let those real numbers sink in. 2. Honestly assess whether your current retirement plan has any provision for long-term care costs. If the answer is no, that is your gap. 3. Consider contacting an independent insurance agent who specializes in long-term care products or an elder law attorney for a no-obligation conversation about your options. Because the cost of planning is always, always less than the cost of not planning. Drop a comment below and tell me, do you have a long-term care plan in place? Or is this the first time you've really thought about this? Let's talk about it. If this video opened your eyes to something important, please share it with someone you love who needs to hear it. And give it a like if it helped you. Subscribe to Life Advice for a new video every single week. I will see you in the next one. Take care.